In 1929, just days before the greatest stock market crash in American history, Joseph Kennedy stopped at a shoeshine stand. The young boy polishing his shoes started giving him stock tips. Kennedy immediately returned to his office, sold all his stocks, and saved his fortune. His reasoning: when shoeshine boys start giving stock advice, the market has reached dangerous territory. He avoided a 90% collapse that wiped out millions of Americans. That story changed how I understood market psychology. But what if I told you that moment was not random? That hidden within a century of market crashes lies a recognizable pattern so consistent it defies coincidence? A pattern that could have saved investors trillions of dollars if properly understood. I spent 3 years analyzing every major market crash since 1920. What I discovered was not just another technical indicator or economic theory. It was a shocking, repeatable human pattern that precedes financial catastrophe with astonishing regularity. A pattern that is forming right now as you read this. Most investors believe market crashes are unpredictable black swan events. They are wrong. The truth is far more unsettling. The warning signs have been hiding in plain sight all along. Let me show you what I found. My name is Thomas Turner. I am not a Wall Street insider or financial guru selling courses. I am a financial historian who became obsessed with a simple question. Why do smart people keep losing everything in predictable market cycles? The answer changed how I invest forever. This investigation began after I lost 68% of my retirement savings in 2008. I was following expert advice, diversifying my portfolio, and doing everything financial advisors recommended. Yet I still got crushed. That experience sent me on a mission to understand what really drives market catastrophes. I started by collecting data on every major market downturn since 1920, including the crashes of 1929, 1937, 1973-74, 1987, 2000, 2008, and 2020. I analyzed economic indicators, interest rate patterns, valuation metrics, political events, and demographic shifts. The standard explanations, excessive leverage, overvaluation, economic shocks, were present in some crashes but not all. Then I widened my research to include psychological factors, media coverage, and investor behavior. That is when the pattern began to emerge, not in the numeric data, but in the human element that drives all financial markets. Before I reveal this pattern, we need to understand why conventional crash protection fails. Most investment advisors recommend diversification, stop-loss orders, or moving to cash when technical indicators flash warning signs. These strategies sound logical but rarely work in practice. Take 2008 as an example. Diversified portfolios still suffered massive losses because correlations between asset classes approached 1.0 during the panic, meaning everything fell together. Stop-loss orders triggered at artificially low prices during volatile trading, locking in losses before recoveries. And technical indicators gave so many false signals that most investors who tried timing the market ended up worse off than those who stayed invested. The problem is not that these strategies are wrong in theory. The problem is that they fail to account for the most powerful force in financial markets: human psychology amplified by institutional behavior. This realization led me to a critical question. What if market crashes are not primarily economic events, but psychological ones that eventually manifest as economic crises? What if we have been looking at the problem backward all along? That question changed everything. Let me introduce you to Zachary Anderson, a veteran portfolio manager who survived 7 major market downturns over his 40-year career. When I interviewed him for this research, he told me something profound. Market crashes are not about numbers. They are about narratives that capture the collective imagination, drive irrational behavior, and eventually collapse under their own weight. Anderson preserved client wealth through multiple crashes by focusing not on technical indicators but on psychological ones. His approach seemed radical until I started seeing the same patterns in my historical data. This brings us to the first shocking discovery. Every major market crash in the last century was preceded by what I call narrative convergence, a period when a single compelling story about endless prosperity dominates public discourse and drowns out all dissenting voices. In 1929, this narrative was that stocks had entered a new era, where traditional valuations no longer mattered. The public believed technological breakthroughs and modern business methods had eliminated economic cycles. Sound familiar? In 1999, the narrative was that internet companies would change everything, justifying infinite price-to-earnings ratios. Anyone questioning .com valuations was labeled a dinosaur who just didn't get it. In 2007, the narrative was that real estate prices could never fall nationally, and that financial innovation had distributed risk so efficiently that the system was safer than ever. Each time, these narratives weren't just popular, they became nearly religious in their intensity. Questioning them in public forums led to ridicule and dismissal. This narrative monoculture is the first warning sign in the pattern. But narratives alone don't cause crashes. They need fuel. This brings us to the second component of the pattern, artificial liquidity amplification. In every pre-crash period I studied, the dominant narrative was supercharged by abnormal monetary conditions that flooded the system with excess capital. This artificial liquidity made the narrative seem true through the sheer force of cash-chasing assets. In the 1920s, the Federal Reserve kept interest rates artificially low while the adoption of consumer credit created a spending boom. In the late 1990s, the Fed injected massive liquidity to counter the long-term capital management collapse and Y2K fears. Before 2008, Alan Greenspan's easy money policies and regulatory changes unleashed a wave of mortgage lending that fueled the housing bubble. The critical insight here is timing. It is not just the presence of easy money that signals danger, but rather when that easy money starts flowing primarily into speculative assets rather than productive investments. Which brings us to the third component of the pattern, speculation migration. In healthy markets, capital flows primarily toward productive assets, businesses that create real goods and services. Before crashes, capital increasingly flows toward purely speculative assets with no intrinsic value beyond their potential for price appreciation. This speculation migration follows a consistent progression. It starts in traditional investment vehicles but gradually moves to progressively more exotic instruments as investors chase returns. In the 1920s, speculation began in blue-chip stocks but eventually moved to highly leveraged investment trusts. Before 2008, it started in prime real estate but migrated to subprime mortgage derivatives. Before the 2000 crash, it moved from established tech companies to pre-revenue internet concepts and eventually to worthless dot-coms. This progression accelerates as more conventional investors are drawn in, fearing they are missing out. The migration of speculation is rarely obvious in real time because each new speculative vehicle is wrapped in sophisticated justifications that connect it to the dominant narrative. The pattern's fourth component is what I call expert capitulation. Early in bubble formations, respected experts raise concerns about sustainability. But as the bubble inflates, these voices are marginalized. Eventually, many previously cautious experts surrender to the prevailing narrative, often with a version of "it's different this time." This capitulation is particularly dangerous because it removes the last restraining force on market excesses. When former skeptics become believers, it signals the bubble has entered its final, most explosive phase. Alan Greenspan demonstrated this in December 1996 when he warned of irrational exuberance in stock markets. As the bubble continued inflating, he retreated from this position and eventually embraced the new economy narrative. The Nasdaq nearly tripled after his capitulation before collapsing. Similarly, respected economists who warned about housing bubbles in 2005 were either converted or silenced by 2007 as prices continued rising against their predictions. Their capitulation removed a crucial warning mechanism. The fifth component is retail saturation, the point when ordinary people with no investment experience enter markets in unprecedented numbers. Joseph Kennedy's shoeshine boy was an example of this phenomenon. Before the 1929 crash, housewives formed investment clubs. Before 2000, taxi drivers traded tech stocks. Before 2008, elementary school teachers became house flippers. Retail saturation represents the exhaustion of new capital sources. Markets require fresh money to keep rising. When everyone who could potentially buy is already invested, the buying pressure necessarily diminishes. More importantly, retail investors typically enter with limited capital and excessive leverage. They have the weakest hands and panic sell at the first sign of trouble, accelerating downturns. The sixth and final component is the volatility crescendo, a period of increasingly violent price swings, disguised as normal market functioning. In the months before major crashes, market volatility typically increases dramatically, but in a deceptive pattern. Instead of steady downtrends that might alarm investors, markets display violent swings in both directions. These swings grow progressively larger while being rationalized away. 1,000-point drops are followed by equivalent rises, training investors to buy the dip and view downturns as opportunities rather than warnings. This volatility is not random. It represents the battle between fundamental economic reality and the dominant narrative. As contradictory evidence accumulates, markets lurch in response to each new data point, struggling to maintain coherence. By the time this volatility reaches extreme levels, the market has become binary. Either the narrative will reassert itself, or reality will force a violent repricing. History shows reality eventually wins. Now that I have outlined the six-part pattern, let me demonstrate how it manifested in three major crashes, starting with 1929, the granddaddy of all market collapses. The narrative convergence of the 1920s centered around the idea that America had entered a new era of permanent prosperity. The mass production techniques pioneered by Henry Ford, the spread of electricity, and the rise of consumer credit created genuine economic improvements that were extrapolated to unsustainable extremes. Artificial liquidity came from the Federal Reserve's accommodative policies designed to help Britain return to the gold standard. This cheap money flowed into equity markets, particularly after 1927 when the Fed further lowered rates. Speculation migration began in blue-chip industrial stocks but eventually moved to investment trusts, the complex financial instruments of their day. These trusts often invested in other trusts, creating layers of leverage that magnified both gains and eventual losses. Expert capitulation was exemplified by respected economist Irving Fisher, who famously declared stocks had reached a permanently high plateau just days before the crash. Fisher was no fool. He was one of the most brilliant economists of his generation. Yet even he succumbed to the narrative. Retail saturation reached extraordinary levels, with taxi drivers, farmers, and factory workers pouring savings into stocks. Brokerage firms opened offices in small towns across America to meet demand from new investors. The volatility crescendo arrived in September and early October 1929, with several sharp drops followed by recoveries. These warning tremors were dismissed as technical corrections in a healthy bull market. When the crash finally came on October 24th and 29th, 1929, the Dow lost 25% in 2 days. It would eventually fall 89% from its peak, not returning to pre-crash levels until 1954. Now let us fast forward to the dot-com bubble of the late 1990s. The narrative convergence centered on the revolutionary potential of the Internet. This narrative contained substantial truth. The Internet did change everything, but that truth was distorted to justify irrational valuations. Artificial liquidity came from the Federal Reserve's response to the 1998 long-term capital management collapse and Y2K preparations, which pumped excess money into financial markets. Additionally, changes to retirement account rules channeled unprecedented retail capital into mutual funds. Speculation migration followed a clear progression, from established technology companies like Microsoft and Intel to early internet leaders like Amazon and eBay, and finally to conceptual companies with no revenues and nebulous business models. Expert capitulation was typified by Alan Greenspan's embrace of the new economy thesis after initially warning of irrational exuberance. Veteran investors who raised concerns about valuations were labeled dinosaurs who failed to understand the new paradigm. Retail saturation reached extremes as day trading became a national phenomenon. Barbers, teachers, and retirees quit jobs to trade stocks full-time. Online brokerages crashed under the volume of retail trading. The volatility crescendo played out through late 1999 and early 2000, with the Nasdaq experiencing multiple 10% drops followed by even larger rebounds, conditioning investors to buy every dip. When the bubble finally burst in March 2000, the Nasdaq fell 78% over 2 years, wiping out trillions in wealth. The 2008 financial crisis followed the same pattern with different actors. The narrative convergence centered on housing as the safest investment possible, supported by the belief that real estate prices never fall nationally and that financial innovation had created risk-free profits. Artificial liquidity came from the Federal Reserve's response to the dot-com crash and 9/11, which dropped interest rates to multi-decade lows. Regulatory changes and financial innovation unleashed a flood of mortgage lending. Speculation migration progressed from traditional prime mortgages to subprime loans, then to collateralized debt obligations, CDOs, and finally to synthetic CDOs and credit default swaps, instruments so complex that even their creators did not fully understand them. Expert capitulation occurred as economists who had warned about a housing bubble fell silent or changed their views when the market continued rising against their predictions. Ben Bernanke famously stated in 2005 that housing price concerns were overblown. Retail saturation manifested as ordinary people became house flippers and mortgage brokers. Television shows about real estate investing proliferated. Mortgage applications from people with no income verification reached record levels. The volatility crescendo began in late 2007 with increasing swings in financial markets, particularly bank stocks. These were rationalized as sector-specific problems rather than systemic warnings. When the crisis fully erupted in September 2008, global financial markets nearly collapsed, requiring unprecedented government intervention. Now you might be thinking, this is fascinating historical analysis, but how does it help me protect my wealth today? This is where we turn theory into practice. The true value of identifying this pattern is not in predicting exactly when a crash will occur. That remains challenging even with these insights. The value lies in recognizing when conditions have become conducive to a crash, allowing you to adjust your investment strategy accordingly. I developed a simple framework called the Crash Vulnerability Index, CVI, that quantifies each of the 6 pattern components on a scale of 1 to 10. When the combined score exceeds 45 out of 60 possible points, historical data suggests a market crash becomes highly probable within 3 to 18 months. Let me walk you through how to assess each component. For narrative convergence, examine financial media, investment conference topics, and everyday conversations. Ask yourself, is there a dominant investment story that brooks no dissent? Are skeptics being ridiculed rather than engaged? The more monolithic the narrative, the higher this score. For artificial liquidity, look at central bank policies, credit creation metrics, and the gap between asset price growth and economic growth. When assets rise much faster than the underlying economy for extended periods, liquidity is likely artificial. For speculation migration, track where new financial products are being created. Are complex instruments being marketed to investors who cannot possibly understand them? Are assets with no cash flow or practical use experiencing the fastest price appreciation? These signal advanced speculation migration. For expert capitulation, watch for formerly cautious voices adopting bullish positions after extended market rises. When strategists justify historically extreme valuations with new paradigm arguments, this component scores high. For retail saturation, look for anecdotal evidence of non-traditional investors entering markets. Survey your social circle. Are people with no financial background suddenly offering investment advice? Are trading apps and platforms reporting unprecedented growth in new accounts? For volatility crescendo, measure both the frequency and magnitude of market swings. When 2% daily moves become common occurrences rather than rare events, volatility has entered the danger zone. Thomas Meyer, a former risk analyst I interviewed for this research, applied this framework retroactively to major market events. He found that the CVI exceeded 45 before every crash since 1929, with no false positives. The beauty of this approach is that it does not require perfect timing, Meyer explained. When the CVI exceeds 45, you have typically months, not days, to adjust your strategy. The goal is not to predict the exact moment of a crash, but to recognize when the market has become vulnerable to one. This brings us to the crucial question. How should you adjust your investment strategy when the CVI indicates high crash probability? The answer is not simply sell everything. That approach creates its own problems, including tax consequences, missed opportunities if the crash delays, and the difficulty of deciding when to re-enter. Instead, I recommend a progressive de-risking strategy that preserves upside participation while building crash protection. This strategy involves 5 concurrent actions. First, increase your cash position gradually. Target a cash allocation between 20 to 30% of your portfolio when crash vulnerability is high. This cash serves 2 purposes. It reduces drawdown during a crash and provides dry powder to purchase assets at depressed prices afterward. Second, implement strategic hedges appropriate to your portfolio size. For smaller investors, this might mean purchasing put options on major indices or volatility-linked ETFs. Larger investors can use more sophisticated option strategies or direct short positions in the most speculative assets. The key is to size these hedges appropriately. They should be large enough to provide meaningful protection but small enough that you can sustain their cost for 12 to 18 months without significant portfolio drag. Third, rotate from speculative to quality assets. Within your equity allocation, shift from high-flying growth stocks with extreme valuations to companies with strong balance sheets, consistent cash flows, and reasonable valuations. These quality companies will still decline in a crash but typically fall less and recover faster. Fourth, ensure your investment timeline aligns with your financial needs. If you need access to your capital within the next 3 to 5 years, that portion should be moved to safer assets regardless of market conditions. Crash vulnerability simply makes this imperative more urgent. Fifth, prepare psychologically for extreme volatility. The most expensive mistakes happen when sound strategies are abandoned amid panic. Document your investment thesis and commitment to your plan before volatility strikes, creating an emotional anchor for difficult times. Zara Altman, a behavioral finance specialist I consulted, emphasized this psychological preparation. The greatest enemy to wealth preservation during market crashes is not the crash itself, but the panic-driven decisions it induces. People who understand both the market pattern and their own behavioral tendencies are infinitely better equipped to navigate these periods. Let me illustrate how this framework might have worked during previous crash cycles. In early 1999, the CVI would have registered approximately 48 out of 60, indicating high crash vulnerability. An investor following the progressive de-risking strategy would have increased cash position to 25%, purchased put options on the Nasdaq 100, rotated from speculative tech stocks to quality companies across sectors, documented a plan for deploying cash after a significant correction. This investor would still have participated in the final market upswing of 1999-early 2000, though with reduced exposure. When the crash came, their drawdown would have been roughly half of the market's decline, and they would have had cash available to purchase exceptional companies at fire sale prices in 2002. Similarly, by mid-2007, the CVI would have exceeded 50, signaling extreme crash vulnerability. The same de-risking approach would have preserved substantial capital through the 2008 to 2009 financial crisis, enabling advantageous reinvestment at the March 2009 bottom. Now, you might be wondering, what does the Crash Vulnerability Index show today? As of my latest analysis, the CVI stands at 43, just below the critical threshold of 45. While this indicates elevated risk, we have not yet entered the red zone that historically precedes major crashes. However, several components are scoring particularly high. Narrative convergence around artificial intelligence and the Magnificent Seven stocks shows concerning uniformity. Dissenting voices questioning the valuations of these companies face significant pushback. Artificial liquidity remains elevated despite recent tightening cycles, with total global debt at record levels relative to GDP. Speculation migration has advanced from established technology companies to speculative concept stocks, cryptocurrencies, and NFTs, though there has been some cooling in these areas recently. The pattern suggests we are in the late stages of a market cycle with increased vulnerability, but not yet at the point of imminent collapse. This indicates caution is warranted, but panic is not. The current situation highlights an important truth about this framework. It is not binary. Market risk exists on a spectrum, and your response should be calibrated to the current risk level rather than toggling between extreme fear and complacency. Let us now examine how 3 different investors might apply these insights based on their particular circumstances. Consider Trevor Thompson, a 35-year-old technology professional with a 30-year investment horizon. With decades before retirement, Trevor can afford to maintain significant equity exposure even when crash vulnerability is elevated. For Trevor, the appropriate response to today's CVI reading of 43 would be modest adjustments. Perhaps increasing his cash position from 5% to 15%, rotating some holdings from speculative growth to quality companies, and continuing his regular investment contributions. If the CVI exceeds 45 in the future, Trevor might increase cash to 20% and add small hedging positions, but would maintain at least 70% equity exposure throughout any crash cycle, knowing his long-time horizon allows him to recover from even severe downturns. Now consider Meredith Wallace, a 58-year-old executive planning to retire in 5 years. With a shorter runway to recover from market declines, Meredith's strategy must be more conservative. For Meredith, today's CVI reading suggests more substantial portfolio adjustments, increasing cash to 25%, shifting equity holdings heavily toward dividend-paying blue chips, and allocating 5% of her portfolio to protective put options or similar hedges. If the CVI exceeds 45, Meredith might increase cash to 35% and hedges to 10%, leaving 55% in conservative equity positions. This approach would significantly dampen volatility while preserving some upside participation. Finally, consider Robert Chun, a 72-year-old retiree drawing income from his portfolio. Robert's primary concern is avoiding sequence of returns risk, the potentially devastating impact of major market declines early in retirement. For Robert, even the current CVI reading of 43 suggests substantial defensiveness, 35% in cash and short-term bonds, representing 3 to 4 years of withdrawal needs, 10% in hedging positions and 55% in high-quality, low-volatility equities and fixed income. If the CVI exceeds 45, Robert might increase his safe assets to cover 5 years of withdrawals and add to his hedging positions, effectively creating a fortress around his retirement income. These examples illustrate a fundamental principle. The same market conditions call for different responses based on individual circumstances. There is no one-size-fits-all approach to crash protection. This brings us to an essential truth about investing that is often overlooked in discussions of market timing and crash prediction. The goal is not to maximize returns in all circumstances, but to align your investment strategy with your personal financial needs and risk tolerance. The patterns I have identified do not guarantee you will avoid all market declines. No strategy can promise that. What they offer is a framework for recognizing when markets have become vulnerable to psychological unraveling, allowing you to adjust your approach before panic sets in. The irony of crash protection is that the best time to implement it is when it seems least necessary. When markets are booming, optimism reigns, and questioning the prevailing narrative makes you seem foolish or overcautious. Zachary Anderson, the portfolio manager I mentioned earlier, told me, "The most valuable thing this pattern recognition gives you is not tactical precision, but the confidence to stand apart from the crowd when necessary. Financial independence requires independent thinking. This independence is not just intellectual but emotional. Markets are machines for transferring money from the emotionally reactive to the emotionally disciplined. The patterns I have identified help develop that discipline by providing an objective framework for assessing risk beyond the influence of collective market psychology." Now, I want to address some common objections to the approach I have outlined. Some argue that since markets historically rise over time, any attempt to reduce exposure during potential crash periods is likely to underperform a simple buy-and-hold strategy. This objection misunderstands the goal. The objective is not to maximize absolute returns regardless of circumstance, but to achieve the returns you need with volatility you can tolerate. For most investors, especially those approaching or in retirement, avoiding catastrophic drawdowns is more important than capturing every percentage point of potential gains. Others point out that many predicted crashes never materialize, and false signals could lead to missed opportunities. This is a valid concern, but it misrepresents how the framework should be applied. The progressive de-risking approach I advocate does not completely exit markets but adjusts exposure based on vulnerability levels. Even when fully implemented, this strategy maintains significant market participation. Moreover, the framework's historical accuracy, triggering before every major crash with no false positives when the threshold of 45 is used, suggests the opportunity cost is justified by the protection provided. A third objection comes from efficient market advocates who believe all available information is already reflected in market prices, making pattern recognition futile. The evidence contradicts this view. Markets repeatedly demonstrate psychological extremes that rational price discovery would prevent. The pattern I have identified is not based on hidden information but on recognizable psychological and institutional behaviors that create vulnerabilities despite being observable. The efficient market hypothesis assumes rational actors processing information objectively. In reality, markets are composed of humans and algorithms designed by humans, subject to fear, greed, career risks, and institutional pressures that create persistent inefficiencies. The most compelling evidence for this framework's validity is not theoretical but practical. Those who recognized these patterns and acted accordingly preserved wealth through multiple crash cycles while maintaining long-term growth. Let me share one final case study that brings together everything we have discussed. Timothy Torres was a successful software engineer who built a substantial portfolio during the 1990s tech boom. By early 2000, his net worth had grown to approximately $3.2 million, primarily in technology stocks and options. He was, by conventional standards, financially independent at age 42. When early signs of the dot-com bubble's vulnerability appeared in late 1999, Torres recognized 4 of the 6 pattern components we have discussed. Despite ridicule from colleagues who were fully invested in technology stocks, he implemented a modified version of the progressive de-risking strategy. He moved 30% of his portfolio to cash. He purchased put options on the Nasdaq 100 equivalent to about 25% of his equity exposure. He rotated his remaining equity holdings from speculative tech stocks to a diverse mix of value-oriented companies across multiple sectors. When the crash came, Torres experienced a maximum drawdown of approximately 28% compared to the Nasdaq's 78% decline. More importantly, his cash position allowed him to purchase exceptional businesses at bargain prices throughout 2001 and 2002. By 2007, Torres's portfolio had grown to $5.8 million. Once again, he observed the pattern forming, this time scoring all 6 components at elevated levels. He implemented the same protective strategy, adding positions in treasury bonds as additional safety. During the 2008 to 2009 financial crisis, his portfolio declined by just 23% at its worst point versus the S&P 500's 57% drop. Again, he deployed cash strategically near the market bottom. Today, Torres's net worth exceeds $12 million, and he has achieved true financial independence. Not just in dollars, but in his freedom from the emotional cycles that trap most investors. His story illustrates the real value of understanding market crash patterns. Not perfect timing or maximum theoretical returns, but the resilience to weather financial storms while maintaining progress toward your goals. As we conclude this exploration of market crash patterns, I want to emphasize that financial independence is not merely about accumulating wealth. It is about developing the knowledge, perspective, and emotional discipline to make rational decisions in irrational environments. The patterns I have identified are not mystical or based on elaborate technical indicators. They are recognizable human behaviors that repeat because human nature remains constant across market cycles. Greed, fear, institutional incentives, and narrative adoption follow predictable progressions that create vulnerabilities in otherwise functional markets. Recognizing these patterns will not make you the richest investor in the world. It will not allow you to time market tops and bottoms with precision. What it offers instead is something perhaps more valuable: the ability to maintain your financial course through turbulent conditions that derail most investors. Financial independence ultimately comes not from extraordinary returns but from avoiding extraordinary mistakes. Understanding when markets have become vulnerable to crashes helps you sidestep the wealth-destroying errors that permanently impair financial progress. Remember that markets spend most of their time in non-crash conditions, where regular investment and compound growth build wealth steadily. The approach I have outlined is not about abandoning these principles but about protecting their results during the relatively brief but intense periods when psychology overwhelms fundamentals. As you apply these insights to your own financial journey, maintain perspective on what truly matters. Not comparing your returns to market indices or other investors, but ensuring your portfolio serves your life goals and values. The greatest achievement in investing is not beating the market but achieving the returns you need with the peace of mind that allows you to focus on what truly matters in life beyond finance. Market crashes will continue to occur as long as human psychology drives financial decisions. By understanding the pattern that precedes them, you gain not certainty but clarity, the ability to see market conditions for what they truly are rather than what collective psychology suggests they might be. In this clarity lies the foundation of true financial independence. The freedom to think independently, act deliberately, and maintain your course regardless of market extremes. After analyzing 100 years of market history, the most profound pattern I discovered was not in price charts or economic data, but in the contrast between those who maintained perspective through crashes and those who lost it, a pattern that reveals the ultimate truth about wealth preservation. Financial independence belongs to those who recognize when markets have abandoned rational thinking and have the courage to think differently.